Welcome to This Explainer. Today, we're literally putting on X-ray glasses to look right through the absolute core of the global economy. Think of this as your ultimate masterclass, where we'll be decoding the entire DNA of business. My goal today? It's pretty simple, actually. By the time we wrap up, we're going to transform you from an ordinary, everyday consumer into an active, strategic player in the economy.
Right, let's dive right in by asking the ultimate question. How exactly does a basic, everyday concept turn into a massive corporate machine that basically dictates our daily lives? I mean, how does a random idea go from a quick sketch on a napkin to a titan like Amazon dropping packages at your front door in 24 hours?
To answer that, we're going to unpack the whole thing systematically. We'll start with the game of scarcity, then look at structuring your business, the 5 management functions, the math of profit, marketing and supply chains, and finally, funding and scaling up.
Okay, Section 1, the game of scarcity.
We've got to start with the fundamental flaw of our planet, which, believe it or not, is the whole reason businesses even exist in the first place. Just think about it. You want great food, a premium house, a shiny sports car, the absolute latest smartphone. But there's a massive glitch in the real world. This planet just doesn't have enough stuff to give everyone everything for free. Your desires are totally unlimited, but our resources very limited. Because we can't just snap our fingers and have everything instantly, someone has to step up to produce, store, and market these limited resources. That incredibly powerful, sometimes brutal engine that creates tangible products out of thin air? Yeah, that's what we call a business.
Moving on to Part 2, structuring your business.
We can actually watch this economic engine evolve in real time if we follow a young, ambitious entrepreneur named Ravi. So on day 1, Ravi starts out as a sole proprietor. He's a one-man army making rapid-fire decisions at his tiny corner coffee stall. He is the boss, the barista, and the cleaner. But, the workload eventually crushes him. So by year 1, he brings in his childhood friend Amit to scale up through a partnership deed, which instantly doubles their capital. Then, the magic really happens. By year 2, their coffee goes so viral they expand to 10 cafes. But here's the thing, running 10 cafes is nothing like running one tiny stall. The risks absolutely multiply, so they eventually have to form a private limited company.
And this move brilliantly illustrates why the company structure is considered by many to be the greatest human invention right after the wheel and fire. See, when Ravi was a sole proprietor, he had unlimited liability. If a short circuit burned down his stall and the neighboring shop, the courts could legally seize his personal bike, his TV, even his home to pay off those debts. But with a private limited company, we get limited liability. The law suddenly views the company as a separate, artificial, living person. If the business goes bankrupt now, Ravi and Amit's personal homes and cars are perfectly safe. It completely frees up founders to take massive, bold risks without the paralyzing fear of losing absolutely everything.
But there's a huge catch here. A company doesn't just operate in a vacuum. It has to constantly dodge these uncontrollable external forces in the business environment, which we usually map out using the PEST framework. A sudden political ban on plastic cups? That can turn your entire inventory into garbage overnight. An economic recession hits? Your customers are instantly going to ditch your premium 300 rupee lattes for a 5 rupee instant coffee they can make at home. And technologically, an AI-driven vending machine could wipe out your traditional barista model in a matter of seconds. I mean, just look at Nokia and Kodak. They failed to adapt to these exact forces and were entirely wiped off the map.
Which brings us to Section 3, the 5 management functions.
To survive that chaotic, stormy external environment, a company absolutely needs a steering wheel. And these are the 5 specific gears that have to turn in perfect harmony inside the engine room of management. Step 1 is planning, actually deciding where the company is headed. Step 2 is organizing, figuring out who reports to who so there isn't total chaos. Step 3 is staffing, because trust me, one terrible hire can ruin your entire culture. Step 4 is directing, which is all about inspiring those brilliant minds to actually care about your vision. And finally, Step 5 is controlling. Without all 5 of these working perfectly together, even a Fortune 500 company will crash like a sports car driving completely blind.
I really want to pause on that last gear for a second because controlling is so often overlooked, but it is everything. Imagine you plan for 50 million in sales this quarter, but the final numbers come in and you only hit 20 million. That massive gap? That's a deviation. Controlling is catching that failure, finding the root cause, and fixing it immediately. The crucial takeaway here is that all your brilliant planning is completely, utterly meaningless if you aren't rigorously controlling and adjusting when your actual results fall way short of your goals.
All right, Part 4, the math of profit.
Now that our company is managed,
Let's step down into the financial engine room and see how all this builds into the ultimate mathematical equation of business survival. Revenue minus cost equals profit. It sounds ridiculously simple, right? But so many massive startups burn through their cash and die because they just misunderstand costs. Costs basically split into two camps. COGS, or cost of goods sold, are your direct ingredients, like Ravi's coffee beans and milk. But OPEX, your operating expenses, well, these are the silent killers. These are fixed costs, like massive shop rent and employee salaries. And why is this so dangerous? Because fixed operating expenses demand to be paid, even if a citywide curfew hits and you have literally 0 customers for an entire week.
And that brilliantly illustrates why hitting your break-even point is the very first monumental victory for any new startup. It's the exact, magical number of cups of coffee Ravi has to sell where his revenue finally covers all those fixed rents and variable bean costs. At this specific point, his profit is exactly 0. But selling just one single unit above this line, that is when the company finally generates real, tangible money.
Now, some businesses have a wildly unfair advantage here. Tech and software startups can often hit staggering 80 to 90% gross profit margins. Why? Well, simply because once you write a piece of software, copying and pasting that code across borders to millions of new users costs virtually nothing in raw materials.
But remember, gross margin isn't the final word. You still have to pay taxes, marketing, and rent to get your actual net profit. Standard retail and restaurant businesses, they're out there fighting brutal dogfights for a measly 2 to 5% net margin. Compare that to a giant like Apple. Apple consistently shocks the financial world by parking a massive 25% or more net profit directly in the bank, despite dealing with complex physical hardware. And this is driven entirely by their undeniable brand moats, the power of an ecosystem that customers just refuse to leave.
Let's move to Section 5, Marketing and Supply Chains.
So how exactly do you convince someone to pay those premium prices, like dropping over 100,000 rupees on a smartphone when so many cheaper options exist? You do it by mastering the 4 Ps of marketing. Look at how Ravi uses this. He isn't just selling roasted bean water anymore. By upgrading his product to premium minimalist green cups, he's actually selling Instagram status. For price, he uses value pricing, charging based on what the customer is willing to pay for that status, not just what the milk and beans cost him. Through direct place, distribution, and targeted psychological promotion via PR and ads, Ravi is executing a highly sophisticated psychological hack right on his customers' minds.
There's a brilliant quote to remember here. Selling is what happens when the box leaves the factory. True marketing happens before the product is even created. Marketing is all about figuring out the exact emotional gap in the public's life and engineering a miracle that perfectly fills it.
And once this brilliant marketing creates a massive, overwhelming surge in demand, the silent, dark hero of the business world has to step in, the supply chain. When Ravi expands globally, he's now dealing with complex international supply chains. Importing tons of Colombian beans means navigating customs, letters of credit, and flawless inventory management. Perfecting this flow ensures the fresh beans arrive at the exact moment the old stock empties out. If he buys too much, too early, his precious cash gets trapped sitting completely uselessly in a rented warehouse.
Finally, Section 6, Funding and Scaling Up.
Upgrading from local street shops to complex international supply chains requires a massive injection of fixed and working capital. So where does all that money actually come from? There's a pretty clear evolution here. Step 1 is retained earnings. You're just reinvesting your own early profits. It's safe, but it's really slow. Step 2 is debt, taking out bank loans. But this brings the terrifying risk of monthly EMIs that you have to pay even if you're losing money. Step 3 is where things get crazy, venture capital. This is the high-stakes game where wealthy investors hand you massive backpacks of cash, trading it for a chunk of your company's equity, hoping for an explosive, exponential boom. And if you somehow get huge enough, you hit Step 4, the IPO.
An IPO is the primary market. It's the very first time the company directly offers shares to the general public to raise billions in capital for massive global expansion. It essentially bridges the gap from a private empire to a publicly traded asset. From that day on, those shares enter the secondary market, like the stock exchange. That's where everyday people sit in front of their screens buying and selling those existing shares back and forth based on chart speculation and quarterly profit reports.
And all of this builds up to the ultimate purpose of today's explainer. You now possess the underlying blueprint of the economy. You know exactly how businesses engineer supply chains, scale operations, and leverage the stock market to build insane wealth.
But in today's landscape of strict consumer protection and corporate social responsibility, the system naturally corrects itself. If a business model relies solely on exploiting the public, it will eventually collapse. Building authentic, tangible value is really the only way to create a legendary, lasting business. So I'll leave you with this final, provocative question. With all this knowledge now in your hands, what actual, meaningful value are you going to create? Think about that for a while. Keep analyzing the world around you, and we'll see you in the next explainer.